As an advisor, first and foremost, our responsibility is to make sure that our clients are well taken care of from a lifestyle and fund standpoint. And our frameworks between the three forms of diversification are what allow us to do that. And so we've been intentional. You get to hear the three forms of diversification. Even within those, all three, between time horizon, asset allocation, and taxes, have then three different frameworks within each of those. Starting with time horizon, that's where we're going to have short, intermediate, and long term. The way that we're going to define that is, for a client, when are they going to need the dollars? Is it going to be over the next 3 years? That'd be short term. Are they going to need it between 3 and 6 years? That's intermediate term. And then 6 or more years is long term. On the short term, the approach would be, why would we be taking risk in the market right now? Let's get what interest we can. Let's maximize interest. Let's make sure that we're doing that in the most effective way possible. But let's not leave that to chance. We can't put our clients in a situation where the market has a big drop and then they're taking from assets that have had big losses on it. So if we start by understanding what they're going to need over the next 3 years, we want to manage that to where we're not taking risk in the market. But if they're not going to need money over the next 3 years, why would we then load up on those type of investments? There's opportunity cost to return that you could be getting. So then the next place that we look is, well, are they going to need money over the next 3 to 6 years? That's intermediate term. Within that, we feel comfortable taking some level of risk, but we certainly aren't going to take market level risk with that. There's just too much volatility that would be there. And so this is where we would expect a portfolio to not necessarily be keeping up with something like the S&P 500. That, again, would be intentional in the way that we're approaching it because of the risk that we're taking, but it should be making a good bit more than what we would be within those short-term investments. And then lastly, we find the majority of dollars are going to end up being defined as long-term. These clients aren't going to need most of their money over the course of the next 6 years. And so within the long term, that gives us a better framework for how much risk are we willing to take? What does volatility look like? How do we sustain that volatility? And we build this in a waterfall-like manner. So for the answer of when clients are going to need money today may not be the same as it will be a year from now. And so as clients have their needs are changing or something like retirement is getting closer, then we're going to start adjusting. We're going to have dollars flow from long term down to intermediate term down to short term, or if we're in a situation where clients are actually living on these dollars, as dollars are outflowing from short term, again, we've got places where they're being replenished that are getting higher returns than where they were actually being distributed from.